Major funding for these broadcasts is made possible by grants from New York Community Bank, Capital One Bank, Perfect Building Maintenance, Chase Commercial Term Lending, M&T Bank, Genova Burns. Additional support is provided by AKA Hotels, Corman Communities, Aerial Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Collins Building Services, Connect One Bank, CPEX Real Estate Services, Cushman & Wakefield, DDG, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Friedman, Handler Real Estate Organization, HAP Investments, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, New York's Window Company, Madison Realty Capital, Matone Group, Mercantile Commerce Bank, Meridian Capital Group, New Banks, Optimum Window Manufacturing Corp., People's United Bank, Rosewood Realty Group, SJP Properties, Sterling National Bank, Stonehenge Partners, TD Bank, Terra CRG, The Continuum Company, The Moynihan Group, and These Friends.
So in the eloquent words of the pitchman from Crazy Eddie, these prices, these times are insane. But what's going on today? Where is the market? So I have my crystal apple over here, and I'm really trying to shine it to find out what's going to happen in the new year as we start the 15th season of the Stoller Report. So I've assembled a couple of people who are good friends to provide their insight on where they see the market. Is the apple going to be shiny? Or is it going to break? Or what's going to happen? My guests today include the legendary Allan V. Rose, chairman of AVR Realty. Peter Darcy, the exceptional banker who's the president, M&T Bank for New York City and Long Island, both Nassau and Suffolk, so you can lend money to this individual over here. And last but not least, my friend Rob Ivanhoe, who's the global chairman for real estate for the law firm of Greenberg, Traurig. So since you were the kid amongst us over here...
Right. I feel like a kid.
I'm happy you feel like a kid. And look, how many bankers would be lending money unless they felt that the kid is keeping active? And he's pretty active with you. How do you see it today? Where do you see the market?
Well, the market is a lot of different things. I mean, New York City is a unique market by itself. And in New York City, you have we do hotels, office buildings, multifamily. I find things very difficult to pay the kind of prices that you'd have to pay to buy a New York City office building today or a hotel. You can't sit down and say, well, we're going to make 4%, 5%, 6%. In most cases, you're not going to make anything until you sell the building. But over the last 10 years, anybody who did that made a lot of money because they sold the building for a big profit.
Years ago, when Rob was with the legendary firm, of Dreyer and Traub, okay? You were over there doing some work, and you and Rob and I, Peter has seen a couple of the recessions, have seen ups and downs in the blips over here. Aren't you a little cautious? I mean, when you go to loan committee and somebody says, I'm buying this land for $1,000 a foot, or I'm buying this land for in Long Island City, and people are now saying Brownsville. I mean, all this. How do you look at it? How does your credit committee make the decision?
Yeah,
especially when you have Warren Buffett as a large shareholder.
Yeah, so our business model and where we're the number one performing bank stock of any bank in existence of the top 100 when our current regime basically bought and took over the bank in the mid-1980s. So the business model that's worked for us, a sustainable model for this industry, has been to have very low credit losses, control expenses, and make very prudent acquisitions. The controlling credit costs requires, at this point in the cycle, when competition and there's a lot more liquidity heats up, being able to maintain discipline. And how do we do that? We have to, unfortunately, stick to our knitting and pick who we do business with really carefully. We'll push for Allan, and we'll push really hard. We'll do a lot for Allan, but we have a tremendous sponsor. We have a great track record with.
But here's the question. Rob has clients, over the years. Rob's been practicing close to 40 years, not yet, but 35, I think.
Close to 35.
Close to 35 years, and he's seen different players come into the market. Okay, years ago he was involved with the Plaza Hotel. That was the Israelis. Now he's involved with the Chinese in the Waldorf and also in the Baccarat Hotel. Now there's something. Years ago, we remember the term tax shelters. There are no tax shelters now. We have something called EB-5s. As you were saying prior to the show early, interest rates change. I mean, there are new players, and it's really difficult to analyze what's going on. I mean, true, I'm basically the conservative pessimist, as most people know, but I'm trying to be exuberant to a point. But I'm seeing people pay prices which are crazy. How do you counsel the clients, okay?
Well, fortunately, they don't ask me for a crystal ball. They've decided usually that they're buying something,
right.
and ask us to execute on it. I think my view of it is that you have a different kind of buyer and a different kind of owner than we've had, in New York for the last few years. And when I look back to the early stages of my career, there was a New York real estate group that dominated the industry, and they were families, and a lot of them are still Peter's customers, and they're still there, but they're not involved in buying, a major New York City office building.
I think
at
you're right on
rate.
it, because we haven't seen in the last 2 years or so the major buildings being acquired by a major family of New York City.
No.
You do see some of the good people like the File organization buying certain properties, but people are buying properties for the reason of tax deferment. If we didn't have 1031 exchanges, a lot of the sales wouldn't take place. And then people who have this money say, I got to use it for something else. And it's like parking their money somewhere else.
I think there's a basic point that's more important than all of this stuff. The EB-5 it's a good thing, but it's not really dramatic.
It's limited.
Right.
Yeah.
All of the buyers that have paid tremendous amount of monies for office buildings in New York City were in an era where the exchange rate worked very much in their favor, where the dollar was weak, the euro was high, so they were getting, in some cases, 25, 30, 40% discounts. So whatever they paid at that time looked good. But that situation has changed completely. Europe, we have a better exchange rate with Europe. They're going down, we're going up. Asian is the same way. So I think there's not going to be that kind of frivolent money, or even those people came to New York and spent all that money in hotels and shops and things. Fortunately or unfortunately, I think we're going to live with that situation for quite a while.
Okay, but let me preface the question that I brought up before. The point is, we have an administration in place today. There's going to be a change. There are people who are talking about changes in the tax law, like the 1031.
Eliminate.
If we eliminate the exchange situation, don't you see the world changing in real estate?
Well, I think it will make people, have a greater barrier to selling real estate. There's no question about it. Any individuals or families that own real estate are always highly tax motivated. They often have an extraordinarily low basis in the property if they've owned it for a long time, and they want to carry over their low basis into other things. And if that's eliminated, there were some studies done that I've read as to how much it'll reduce transactional activity, and it's pretty significant. And powerful lobbying groups like the Real Estate Roundtable and others are trying to deal with it because it'll impair transactions. It'll make it harder to invest. It'll even make, a scarcity of product for people to buy. So the same amount of money will be chasing fewer properties because of an elimination of 1031 should that happen. And that could create a bubble. So if the Fed and the Congress care about bubbles, and I think they do, because the last bubble when it burst in 2009 was very unpleasant. I think that they should pay attention to things like that.
What about the non-bank lenders? If you've been reading the articles and seeing that's become a big item. I mean, Allan, you haven't really borrowed from the non-bank lenders. How do you see that today? Where are they in the stack?
Well, there are different categories of them. I mean, some of them are public companies.
Right, the Starwood Realty
like
Trust, right?
Starwood is public company. Some of them are basically a fund type structure where they go raise money and then they leverage it with other money and put money out as debt, and they invest all over the capital stack, not just doing mortgage loans, but mezzanine lending, preferred equity, and they're much more flexible. Look, they're more expensive. A lot of times people go to those types of lenders to get more leverage or less recourse.
I'll give you an example, and I was just looking at it the other day, and I'm not sure because I was reading the New York Times. There's this discussion about the wheel in Staten Island. And last season I did a show on Staten Island. So the wheel, the concept is to follow the wheel in London, and that the wheel is one of the items that the tourists from around the world will be one of the stops, like the World Trade Center, the Empire State Building, and eventually, related to the Hudson Yards Exhibition Hall. In the Times yesterday, they said that the financing came in at a 10.5% from a non-bank lender. In addition to that, part of the financing, this is a $500 million deal, right, Allan,
wow,
came in from EB-5 money, which is the immigration program, which the Real Estate Roundtable is also supporting the increase over there. That's a rather speculative situation. Now, what it also said is that the original partners in the transaction, who happen to be very well-established real estate players that we know, it seemed like they may have left the transaction.
I'm not, and we're close with them, and I'm not going to comment on that part of it, but what's happening from a banker's perspective, I think the shadow banking system is a really important mix because the regulatory environment has changed the way banks approach everything. So it's come down to a capital planning focused model where every bank is sort of being pushed into having similar models at how they look at everything. And that's creating some commonality in a lot of ways, and it's going to leave some people out of the mix and unable to get certain types of loans. So the shadow banking market, the people who can't get traditional loans because that capital is getting scarce if it's for construction loans or something called a high volatility commercial real estate loan as a new designation. So certain things that fall into certain buckets are harder to get. That's all flowing out of the system, and the people who can get bank financing are the higher quality borrowers that will pay less, and those that have to gravitate out and pay more, you're pushing the risk out of the banking system, putting it into another place, but it is a new world, and there are huge amounts of capital that's been raised to facilitate that.
But that situation always existed. I remember on Court Street, right? 16
before my time.
16 Court Street.
Yeah, 16 Court
where
Street.
Where the prime rate was 5. If you were lucky, some Shylock in that building would lend you the money at 16%.
We called them a traditional.
So it's a different name, but it's the same theory. It's for people who can't borrow at normal rates.
Years ago, I did meet one of the people that you're talking about, the legendary K.B. Weissman.
Oh, yeah.
And K.B. Weissman, I said, Mr. Weissman, how do you evaluate a transaction? And he said, tell me how many rooms there are in the building. I lend money by the number of rooms. And he had a pretty good track record. Per room. He had a pretty good track record. So where for somebody who's new, who's looking around here, where are the opportunities in the tri-state market for the real estate world? What do you see? Zoning is finally taking place. 25 years in Yaphank, you finally break ground.
Let me tell you what I think is happening. Traditionally, every municipality in the entire area always figured out what they can do to stop the project. You couldn't get zoning, you couldn't get this, you couldn't get that. But every municipality is bankrupt today or near it. And what they're striving for now is to create density, where they only allow like 3 houses an acre, and you can now build 200 apartments. So there's a much better chance of getting properties zoned. Now, the more of that's going on, the lower keeps the prices down on the real estate, because why pay for a zoned piece of property when you can go get your own zoning? So I think that's a very big factor. There's also various geographical areas, like we're building out in Yaphank, Long Island. We have 2,100 acres on the LIE, and there's just need for new stuff. There hasn't been a new apartment house built there in 20 years.
But I think there's a need for housing. The city and the region is growing, and people need to be living over there. Now, the positive thing is that there's an affordable component in Long Island, as there is an affordable component here. But Rob wasn't here when I brought it up. In Long Island, under the Long Island Housing Partnership, the people have to get re-registered each year to qualify for the apartment, as opposed to being in New York, where they're permanently they're protected for the rest of their life. Now, we need the apartments and like transit-oriented. Wyandotte, which was a terrible neighborhood. There's Wyandotte Landing over there. And there's transit-oriented developments like they have now in Connecticut and more in Pennsylvania.
Yeah, the hub in Ronkonkoma is a big thing
over there.
And we're actually putting in a train station in our development. So that's the thing to do. Have a transit-oriented development. People don't want to own houses. There's got to do a lot to get somebody to buy a house. Years ago, it was every American's dream.
That was the American dream.
Yeah.
Well,
two kids and a car in the garage. That's no longer true.
What about retail? I mean, I had a couple of weeks ago, I had Elliot Spitzer on my show, and Elliot was talking about the sale of the Crown building. And he said, look, we thought of converting it. We just didn't believe that the retail and everything could go there. The retail prices, and if you listen to Allan's comment before about the exchange rate and everything, these stores which are being traded on Fifth Avenue at record prices, and that the money is, the Europeans don't have as much money, and the change of exchange rate, retail has been crazy.
Absolutely. I mean, that if any of the asset classes, that's where we see the most aggressive cap rates, the prime retail, and from the escalations from 2009 or 10 on Fifth Avenue, which is clearly morphing. If you look at the sales and some of the leasing activity going down to 43rd Street now on Fifth Avenue, it's really that part of the high-end retail district is starting to accelerate that change, and there's some other things in the works, I think, that'll continue that trend. And Madison Avenue is on fire, the leasing there. I think this headwinds question about foreign tourism, the foreign visitors to New York actually had not dipped in the first half of the year. I think that's likely going to change. It would just make sense that it would. So I think hotels will have the most acute impact from that and all the supply and the Airbnb and all the other headwinds there. But the high-end retail, that's an open question mark. With interest rates going up, that's probably a drag unless there's really good economic growth that comes along with it. If interest rates do indeed go up, which is more likely than not at some point. But this exchange rate issue has to hit the profitability of these stores.
Well, if you look at the history of the recessions, all these rents we're talking about, which are sky high today, went down over 50% when the market turned bad. 2009, the Reagan tax simplification thing. Then there's another factor too, that when you go to buy buildings today, like most of them from Easthill or guys like Easthill, you get a pro forma that shows that when the office tenant goes away, the rent goes from $60 a foot to $6,000 a foot. But sometimes that don't happen for 5 or 6 years, and you're asked to stay there and support the building until that happens. And who knows in 6 years whether the rents are going to be where they are today.
Predict, and
I don't think you can predict today what's going to happen, because just like the hotels were overbuilt and the office buildings were overbuilt, the high-end stores are being overbuilt. You just can't have all those stores at $3,000 a foot.
Right. Now, when you're talking about speculative, the good part of this cycle is that we don't see the banks speculating on office buildings. The new office buildings being built in New York City are not spec. Related, your client is building, buildings where they have tenants in place, or the discussions are over there. The big question that a lot of people had, including myself, was how successful would the Hudson Yards to attract people? They are attracting people. They're attracting tenants. They're running 7 days a week. Besides the Hudson Yards, Brookfield's development is doing very well over there. Times Square, as we were saying before, the retail in Times Square is doing well. The negative of that is that the city can have an effect, because people from around the world read the newspapers and they see what's happening in the city over here with the administration and everything. They're worried about, the retail over there. What about, Allan brought up Long Island. What about New Jersey? I know that you're very active in New Jersey, both of you. Have you seen your clients or investors have an interest in the Garden State now?
Well, again, I think it depends on sector somewhat. I'd say there is certainly an interest and activity in building multifamily or even condominiums in places like Jersey City and the waterfront that are redeveloping. I think the office sector, on the other hand, is very challenged, and there's not enough job growth. There's an overhang of office space that was built in the 70s and 80s that's has a lot of trouble being absorbed. We're in the process of actually moving our New Jersey office right now. And every time we have to look at the New Jersey market, it seems that the rents are always pretty much the same. They really don't go up very much.
But wasn't that similarity, Allan's been in Yonkers for many years. The Westchester market had that situation.
Westchester market has not really come back.
No.
I mean, I would say 5-6 years ago, the price of an office building was $100 a foot in Westchester. You can go on 287, which they call the Platinum Mile, and buy any one of those buildings for $40 a foot today, which is, you can't even make the deal work at $40 a foot. The only hope there is rezoning, and the rezoning would be bad.
But part of that situation that they try to resolve, and I know that Matt Calley was planning it before, was the conversion of certain of these office buildings to residential.
Minute.
Very minute.
With very few
not that
zonings
much of that.
in place. Wouldn't you say so?
Yes.
Minute.
Yes.
There's one thing we were talking about before about office buildings. There are certain situations in New York where, let's take Hudson Yards. The city has given them so many goodies, tax abatements, key money, all kinds of things. A subway, right? A benefit subway.
$1 billion.
Now, if you own an office building that has none of those, it's like from 25 years ago, your taxes are going up to a point that's perilous. I don't know if you've looked at any.
Yes. The tax movement on
when the abatement is going to run out on 5 Times Square, the taxes are going to be $35 million a year in that building, where we're paying 2 or 3, because of the abatements. So that's an opportunity if you're politically connected and you know how to do these things. And you get enough goodies from the city.
Speaking of that, and I think Rob is involved with this also, finally the administration, and it wasn't the administration who was against it, it was the unions and certain other people, Vanderbilt, S.L. Green is converting, so there's the Midtown zoning, taking some of these buildings which are really obsolete and changing that.
There's tremendous functional obsolescence in Midtown office buildings. And that's one of the reasons I think that Hudson Yards and including Brookfield's project, and Tishman Speyer has something on the drawing boards, and Moynihan. L&L. Well, they are at least they're doing new buildings in the old core.
Right.
But one of the reasons I think people are looking over at the West Side and downtown to some extent also is because of the functional obsolescence of so much of Midtown. And what's truly considered world-class A+ office space, it's not in Midtown New York, except for like that's L&L's strategy. They're building a great new building on Park Avenue, and they're completely changing, the building at 380 Madison.
The Jersey City.
New Jersey.
Look at
And
Jersey. The
Tribeca,
Jersey
all of
City
that,
opportunity
all of
for downtown, but which is what people are believing will also help the Staten Island housing market. There's this perception.
Well, that remains to be seen.
No, I agree with you.
A big leap.
But there is a big perception that because of the availability of a ferry to Lower Manhattan, that the housing will do rather well. If you work in Lower Manhattan,
the market
okay,
over there?
No, if you work in Lower Manhattan and Staten Island and you're close to Lighthouse Point or the ferry, I agree. But if you work in Midtown, as we would proverbially say, it's a schlep.
Years ago, when you wanted to have a good office building, you were on Madison Avenue, you were on Fifth Avenue, you were near 42nd Street. Now, if you look, you got the West Sides as an area all of itself. You got downtown, it's an area all of itself. And then when they zone this entire corridor of Park Avenue and Vanderbilt, that's going to be another corridor. There are 5 or 6 Midtown South. Now they're talking about Midtown West. Where do you want to go? So what happens is you got 5 times as many areas that people can go to, each one competing against the other, and that's not a good situation.
Well, one thing
for
that
landlords
is I think in Midtown, if they pass a much broader rezoning than they have now, because it's really just a small area that they've rezoned so far, but the original Bloomberg administration planned to do the larger, much larger district around Grand Central and all the way up Park Avenue and the East Side. If that gets passed, it'll take years and years to vacate the buildings to allow them to be redeveloped.
Right.
It's
And assemble sites.
a 30 or 40 year gradual evolution there, whereas Hudson Yards and the World Trade Center, it's like here's a piece of land, go.
If you go to Williamsburg today and you take the L train, you may have to wait 2 trains to get on the L train.
I've heard
Now, I will tell you the similarity. I went last week to Citi Field, which was the same day that the Open was, and I took the train at 42nd Street, which was the second stop on the train, on the 7 train, to get out to Queens. There was no room on the train. So here's what, as a possible thing, it's wonderful that a train's going to the Hudson Yards. The question is, how much can be absorbed with one train?
Well, they're going to have to add a lot more.
With one stop also. Okay, they will add the number, but it is one train with one stop.
Knowledge.
Right, and I think what the city has to do is, like what Allan brought up in Yaphank, he's building a train. We have to look at different alternatives. The ferry system is working more in the city right now to take people from Williamsburg and other parts of the city, and Greenpoint they're hoping, and other parts of Queens and Astoria. But it's going to be an interesting market. So I think, in conclusion, the apple continues to be shiny. Investors continue to want to be here. As Rob and everyone else said, we do remember tax shelters, administrations, 420, the changes in tax laws and the changes also with regard to, tax deferments could have an effect. But the light seems shiny for the future. And I'd like to thank Allan Rose,
Thank you.
Peter Darcy, and Rob Ivanhoe. See you next week.
Thank you.
Follow us on Twitter, LinkedIn, everything. We'll see you again.